All right, you jumped in the market and you bought shares of your favorite company. Yes, it's a huge step and congratulations. And then boom, the stock drops 20% overnight. Like, crap. I know what you're thinking, like, oh my God, like, what was I doing? Why can I be an investor? Like, this is for the pros. I can't be doing this. What am I thinking? I mean, this is a rich man's game. You know what? I'm gonna go and hang out with Brandon and watch Dancing with the Stars. All right, if you know, you know. Let me tell you, you should not worry. If you did your research right and you have a solid company, then I have the strategy for you. And this strategy lives up to Warren Buffett's mantra that says, buy when people are fearful. And that's exactly what we're gonna do. All right, let's go. The natural instinct for people is to sell their stocks when they see it dropping. Like might as well cut your losses, right? Well, not necessarily. If you're making risky financial decisions and investments of companies you really don't know about, then it might be good to sell and cut your losses. But like I said, if you did your research, then you probably should just hold on for a second. And let me tell you why. First, the best move you can possibly do is to smash that like button and subscribe to get more videos just like this. And then next, instead of selling, you should buy more shares of that company. This way, the average cost of your shares in your portfolio actually goes down. And this strategy is called dollar cost averaging. This is when you purchase securities like stocks or mutual funds and whatnot in intervals so you can negate the fluctuations of the market. Well, let's take an example and see how this works, because I'm much more of a visual learner and not so much of reading out of a really boring textbook. So say you had a company that was trading for $100 and you had $100 to spend, so perfect, you just buy one share. The next month, the stock drops to $95 a share. Like, eek, there's a 5% drop, like you should be worried, right? Well, not necessarily. If you feel the stock is still worth $100 a share, but like some news came out or something, then really think of it this way. You're getting it at a 5% discount. So you buy another share. Now you have 2 shares of the company, but now instead of having it for a cost of $100 a share, you have it for $97.50 a share. The 95 plus 100 divided by 2. Okay, now the next month rolls around and sure enough, the stock drops another $5 to $90 a share. Like, come on, stop falling. Okay, this might make you a little nervous, but you did your research on the stock and you find out that the reason it's dropping is because there's anticipation on something the government's gonna do. And you know what? That actually does happen a lot. Anyways, yet again, you buy another share of the company, and now you've spent $285 on 3 shares. And if you have 3 shares at $285 total, then that comes out to $95 a share that you're paid per share. And then the next month comes, but wait, the news came out and it was beneficial for your company, and your company goes up to $100 a share again. So boom, you're back up to what it was when you first bought the first share. And if you had just sat on that one share of the company, then you would be even. One share, $100 a share, then you're just even. Didn't make any money, didn't lose any money. But if you had bought those shares and now you have the average share cost of $95 a share, now you'd be sitting at $5 per share profit based on how many shares you have. And this is exactly why dollar cost averaging is really good for the long term. In 2008, the world went through the Great Recession. And the Dow Jones dropped from 13,000 down to 6,500 in the matter of 2 years. And the sad part is most people sold their investments because they felt like they were watching their life savings disappear right in front of their eyes. But in just 4 years' time, the stock market climbed back up to that 13,000 mark, which was the high before the recession. If you would have been buying more shares in that 6-year period, the 2 years for it to fall and the 4 years for it to climb back, you would have made a lot of money. All because that dollar cost average was creeping down every time you bought more and more shares. So when it went back up, now the cost per share is down here and the value is actually up here. And even better, today, the Dow Jones is around 34,000. That's like a 6 times increase if you would have bought at the lowest point. Now, there are many times that the markets will dip. I mean, it's kind of like a constant fluctuation, and you'll understand that a lot more if you had watched the candlestick video that I did a couple weeks ago. There are resistance and support lines that you can use to kind of gauge when you should enter the market. With dollar cost averaging, you are buying at a point, doesn't matter if it's low or high, but every time you buy it on a low, you may be thinking, oh no, I'm buying it when it's falling down. but when it goes back up, all of a sudden, hey, not looking too bad, are you? Taking advantage of these dips will lower the average cost of your shares, so when it goes back up, your wealth increases with it. That's why I recommend setting up your investment accounts with either mutual funds, stocks, or your IRA to have incremental purchasing of shares, so then you can take full advantage of the dollar cost averaging without having to manually go and buy at certain times. Or if you're younger and you don't have to really rely on all those dividends that you get from all the stocks, have those be reinvested every time they come out. So if there's a quarterly distribution, then every quarter that $10 that you're getting, just have it buy $10 worth of whatever share that is. Especially with Robinhood, you can do fractional shares, so it's not too bad. It's one of the things I do. But please comment down below and tell me, what are some of the things that you do to take advantage of dollar cost averaging, and did it help you during the recession if you were investing back then, or during the pandemic when it started? Did you buy when the market dipped, or did you just wait it out, or unfortunately did you sell? So let me know in the comments below, and remember, don't forget to like and subscribe so I can get more videos like this out to you. Thank you. Come on down, baby.